Welcome to Lunch Money. Coming up, are NS&I savings rates about to get a boost? Where's the best place for your money, a savings account or the premium bonds? And stick around to find out why so many UK companies are becoming takeover targets. Hello, I'm Simon Lambert. Joining me on today's Lunch Money is This Is Money's Lee Boyce and Richard Hunter from the show sponsor Interactive Investor. And later on, we're going to be joined by Ofcom's Director of Enforcement as well. Lee, at the start of September, National Savings and Investments blew competitors out the water with a 6.2% one-year bond. It had a lot of good deals at the time. Many of those have now fizzled out. But there are rumours that the autumn statement might bring another boost to NS&I rates. Why is that?
Simply put, it's an easy way for the government to raise funds without having to sell more bonds on the financial market. So it's an easier way for them to get money in because the public do love an NS&I product. The Treasury backed, some products have protection up to £1 million. And of course, we all love the premium bonds. They have targets every year of how much money they want to pull in. And that could be uprated in the autumn statement. However, that blockbuster 6.2% deal you talk about, in September alone, they pulled in £7.7 billion, largely off the back of that. So it remains to be seen if they'll go any higher than the net financing target it's got at the moment.
And how does NS&I's rates and what it offers to savers influence other banks and building societies? If we suddenly see a bump in NS&I rates again, are we going to see other banks trying to match them and follow suit?
It's absolutely huge. There's such a market for the market. So typically NS&I products shouldn't go to the best buy, top of the best buy tables. Typically they go somewhere sort of mid-level because of the draw that they have from the public. So with that 6.2% rate, for example, it went to the top of Best Buy and blew everything out of the water, and building societies, banks struggle to keep up with that rate. But if they do tinker with things and it goes a little bit higher, banks and building societies, for competition reasons, have to sort of follow suit as well because they don't have the same names, especially some of the smaller ones. So it should lift the whole market.
Now, NS&I also offers something else, the premium bonds. And we love premium bonds, don't we, in the UK?
We love them.
Would raising the funding target be likely to spell good news for premium bond savers as well?
Quite possibly. It seems like the easiest target out of all of the products that it offers, simply because about half of us have premium bonds in this country. They are so popular. But we have seen 7 rises to the underlying rate since summer 2022. So it was at 1.4%. That's now at 4.65%. We've got far more £100,000 prizes and £50,000 prizes, but that doesn't necessarily mean you're going to win any of them. And it depends on how much you invested in them. You could put up to £50,000 in premium bonds.
Okay, so let's take someone who's got less than £50,000.
Yeah.
Let's take someone who's just got a smaller amount of money. Are they better off putting their money in a savings account or the premium bonds?
That's $1 million question, Simon. I think a lot of people wrestle with this in their minds. That underlying rate is obviously with typical luck, so you're not necessarily going to get that 4.65% rate. You could quite possibly get far higher than that if you win £1 million, but the odds are very, very slim of doing that. So if you are someone that is toying that up, at the moment we're at a point where easy access rates are as high as 5.22%. Slightly different product to premium bonds because you're not going to win £1 million with a standard savings account. So if you are someone that's tempted by the premium bonds, my advice would be not to put all of your eggs in one basket. It should be part of a kind of broader package of savings accounts that you have. Having an easy access rate is really important for your everyday emergencies, for example. At the moment, you can get 5.22% on that. I'll crunch some figures for you for the show. So on £10,000, you've got a 1 in 303 chance of winning nothing in a year. So there is a chance, nothing. Right? You've got a 1 in 3,706 chance of winning 50 grand and a 1 in 10,947 chance of winning £100,000. Now, I think those kind of figures, people go, they actually seem quite slim odds in relative to something like the lottery where you don't get your stake back, whereas you do with premium bonds. If you've got £1,000 in there, you've got a 56.5% chance of winning nothing over the whole year. Nothing. So that's something that you've got to consider. Now, I talked about that 5.22% Metro Bank rate. That would get you £522 interest roughly over the course of the year. With £10,000 in premium bonds, you have a 29.6% chance of getting £500 interest over the course of the year. So it's not guaranteed, That Metro Bank rate now is beating inflation, which is important. That 6.2% rate that NS&I was offering up until last month is smashing inflation. So if you took that out, hats off to you. But if you're tempted with premium bonds, there's a lot of wrangling you need to do with your finances and finding out whether it's really a good deal for you.
And go on, tell us the one thing the premium bonds can do that your savings account can't.
You can win £1 million, Simon. There's 2 prizes every month. You're not going to get that with your 5.22% rate. And that, in a nutshell, is why people love premium bonds.
Thank you very much, Lee. Richard, speaking of the autumn statement, is there any hope of anything there to boost UK investors or the stock market?
There could be. I mean, in terms of disposable income, for example, it's become apparent over the last few days that there's a higher possibility of some sort of cut to income tax and potentially national insurance for middle earners. So obviously that would boost potentially disposable income. In terms of estate planning, there are also rumours swirling that we may see some kind of reduction to inheritance tax, which of course is one of the least popular taxes in existence. And there's also been some speculation that perhaps the ISA situation will be looked at favourably in terms of savers, potentially also including some kind of UK company kind of bonus. In other words, you get an extra £5,000 allowance, for example, but it's got to be invested in UK companies. It's probably a bit much to expect something with a forlorn hope that any overarching changes might be made to make the UK market more attractive, but we live in hope.
You spoke there about ideas to make the UK market more attractive. The UK stock market is unloved, but that doesn't seem to be the case when it comes to takeovers, does it? Over the past week, we've seen another couple of medium-sized UK companies become the target of takeovers, Hotel Chocolat and Music Magpie. Why are UK firms attracting so much attention?
I think if you look on the basis of the fact that the market is unloved, part of that results in lower valuations. For example, we crunched some numbers recently. If you look at something like the benchmark index in the States, the S&P 500, that's currently trading on somewhere around 21 times earning. In fact, if you look at the world indices as a whole, they're trading on something like 19 times earnings, FTSE 100, 11 times. Inevitably, therefore, that means that in relative terms, UK firms are looking cheap. The market as a whole is undervalued, particularly in comparison to its global peers. And if anything, there's possibly some surprise that there hasn't been more takeover activity with that in mind.
And are we likely to see more bids for other companies? How much does that depend on how strong the pound is?
It's certainly a factor. Obviously, as a general rule of thumb, a stronger dollar tends to be positive for companies in the FTSE 100, for example, the majority of whose earnings come from overseas and the dollar in particular. But I think one of the things that potentially has been holding this part of the market back is simply that there's been a lot of other stuff going on in the background. Clearly in the States, there's been some recessionary worries and whether the Fed can engineer a soft landing. And we're not quite at that comfortable stage yet where we can actually say that there's a possibility of interest rate cuts, for example, which clearly would boost the market, could potentially increase IPO activity or new issues. And one would expect at that point for M&A activity also to start peaking. So it's very much a possibility should we see some stability over the next 6 to 9 months moving into next year. And as I say, if there's one thing that's slightly surprising given the current depressed valuations is that perhaps there haven't been more deals so far.
Thank you, Richard. Watchdog Ofcom has fined Shell Energy £1.4 million today for not telling more than 70,000 phone and broadband customers they could potentially get a better deal at the end of their contracts. I'm joined now by Suzanne Cater, Enforcement Director of Ofcom, to explain why. Suzanne, welcome to the show. Why has Ofcom fined Shell Energy?
Hi, Simon. Well, Shell Energy actually provides phone and broadband services as well as the more traditional gas and energy services that you might be aware of. So it is actually caught by Ofcom's rules. Our decision today is ultimately about making sure that customers get a fair deal. We've got strict rules in place that mean all telecoms companies have to let their customers know when they're coming to the end of their contract, and also to let them know if there's a better deal that could be available. Shell failed to do this and fundamentally let its customers down in the process. That meant that thousands of people paid more than they needed to for their phone and broadband services, and that is completely unacceptable. So as a result, we've fined Shell Energy today £1.4 million, as well as making sure any affected customers have been refunded.
I think many of us will have ended up in a similar situation to this over the years. I reckon I've probably overpaid for the odd thing. How can customers end up paying too much when contracts end?
Well, a lot of companies offer really enticing promotional deals to customers, and in return, they lock them in for minimum contract periods of around 12, 18, maybe even 24 months. And after that, monthly prices can increase, sometimes quite significantly. And our research has shown that millions of customers are outside of these initial contract periods, which means they're probably paying more than they need to for their phone and broadband services. That's exactly why we introduce rules that mean providers have to tell their customers when they're coming to the end of their contract periods, and also to let them know if there's a better deal available. If you haven't checked recently, whether you're in or out of contract, it's probably worth taking a look. This can really be as simple as just calling your provider and finding out if there's a better deal available.
That's something that we're always telling people to do on This Is Money, but I think companies rely on them not doing it. Is this a warning shot to other companies who may do the same thing as Shell Energy?
Yes, absolutely. Shell Energy's failings here are a serious breach of our rules, and they are now going to pay a fairly hefty financial price. The idea is this sends a message to the whole industry that Ofcom is watching, and we won't hesitate to step in to protect customers if companies don't play by the book.
Thank you very much, Suzanne.
Thank you.
That's all for today's Lunch Money. Thank you for watching. You can watch more episodes at thisismoney.co.uk/lunchmoney or search for This Is Money on YouTube. And don't forget to join us for the next show on Thursday, where we'll look at what the autumn statement means for you. Goodbye.